How might you invest your retirement account? Well, here to talk with me about this is Beau Kemp from Sensible Money. Beau, welcome.
Hey Bob, thanks for having me.
Oh, it's a pleasure having you always, Beau. You've written this article for Retirement Daily about how to invest a retirement account. Where to begin?
Yeah, so I'll start it off by saying that, the last time we talked about choosing the right type of account. So it's whether it's a Roth or a traditional account. And now it's like the next step is, okay, I chose which account I want. Now what do I invest in, right? So there's your 401k, whether it's a Roth or a traditional, every company will give you this list of funds that are available to you. And it can be intimidating as well to figure out which is the right fund for yourself.
So how might you go about deciding?
Yeah, so the main two things that I like to look at are your holding period length, so like your whole time horizon, and as well as are the funds active or passive. And so the first one, the time horizon, to me this is the big one because you have, depending on where you're at, I mean, going back to our last meeting, we kind of focused on the younger crowd. If you're just coming out of college, most people are going to retire around age 65. And like when we run our retirement plans, we have people live, males to 85, females to 90. And so coming out of college, say you're around age 25, you might have 40 years all the way up until retirement. And then there's another 20 on top of that. And to kind of wrap your head around this huge holding period, in a sense, it's really difficult, especially when you're living day to day and you follow the financial news. It's hard to take a step back and think, what's happening today doesn't affect me 40 plus years down the road. And as you get closer to retirement, that's when you're going to start changing your investment philosophy a little bit to better hedge against your sequence of returns risk.
So when I think about time horizon, and you mentioned this in the article, that the longer your time horizon, the more exposure you can have to equities. And you have some time frames around that. Like if your goal is 20 plus years, you're suggesting that you could perhaps invest upwards of 100% in equities?
Yeah. So if you have 20 years, it really depends on how your behavior is. Really, like, personally, I would feel comfortable 15 and up at 100% equities, but not everyone is the same. And so if you're a little more conservative, that 20-year holding period is a good mark to kind of start with. And if you have that long, the theory is you can go through what we just went through in last March, and you can ride that out. You don't have to worry about selling at a down market, because that's the worst thing that you can do, right? Is when everything's down 20, 30, 40%, you don't want to be selling then, you want to be buying. And so if you have that long time frame, you're able to ride those waves a little better. And then as you get closer, so you start to get to that 10 to 15 year mark, that's when you start looking at, okay, I need to make sure that I'm going to have a smooth landing into retirement. So I want to make sure that when I need my money, I have it and I don't have to worry about what the market's doing. So that's when you start to introduce your fixed income to help ease that volatility. And then what I typically, like, when we get within 10 years is when it gets really strategic. Like, you need to, it honestly is best to probably meet with an expert that specializes in retirement. You only get one shot, right? So you want to make sure your retirement works well. If you're retiring, you don't want to be having to go back to work due to financial reasons. If you want to, that's great. But if you don't want the market to dictate what you do in your retirement. And so that's when it turns out to be like, all right, what we do is we build ladders. We want to make sure that first day you retire, that those first 10 years, we have your income ready for you and we don't have to worry about what's happening.
Right. So when you think about investing in equities, there's a couple different options that people have.
Mm-hmm. Yeah. So if you break it down, the first is active and the other ones are passive funds. What I like to do, I cross out all the active funds that are available to me. And the reason for this, so I guess An active fund, what they're trying to do, they'll take a benchmark, say the S&P 500, and they want to beat it. And so these portfolio managers, that is their goal. They want to return more than what the S&P 500 is doing. Well, historically, no one has ever been able to consistently do this, especially for this long of a time frame. People do it every year, but it's not the same person. It's really, there's studies that'll show it's just really like the chance of luck, pretty much. And so the other theory is just to invest to track a benchmark, which are passive funds. And what you'll see those, you might see an S&P 500 index fund in your 401k options. That's going to be a passive fund, and their goal, the portfolio manager, they want to match what the S&P 500 is doing. Historically, this has been a better option. Obviously, there's no guarantees in this business, but to me, it's just, one, it's cheaper. The expense ratios, they're typically lower, and it's really simple. You're getting diversification by buying these passive index funds, because S&P 500 is buying. You have individual stocks within that. You're not worried about picking which stock is the best today. And so, from a simplicity and a cost perspective, it's just this. To me, it's just the best way to invest in these retirement accounts.
What about regional exposure? Many people often focus on the U.S. stock market, but you have some thoughts on that too.
Yeah, so and not every 401k option will have this, but if you look at, Vanguard has a fund they call it the All World Stock Index Fund. And what it does, you're investing in the whole world. In a lot of these funds, you'll see them, they have like a 60% U.S. equity allocation and 40% into international. And in those, there's different variations of their style exposure. So what we typically like to do in that 60% side of U.S. equities, we like to have a tilt towards U.S. small cap value. And the reason for this is over time, and it has to be these long holding periods. This isn't every year, but over time, these have historically returned better than your large cap funds. And so if we have that time horizon to ride these waves, then you know what, we're just going to ride it out. And we're trying to give ourselves the highest probability of achieving the highest return. And this is one of the ways to try to do that. Come the international side, what we do is we tilt to the emerging markets. And it's the same thing. It's the volatility. And, sometimes people think volatility is this horrible thing, but when you have a long holding period, that's what's driving your returns up as well, not just down. And so it's being able to withstand the volatility, and that's where it can help you.
Right. Well, what's interesting is I know you're familiar with, and I trust some of our viewers are familiar with the investment quilts, where people look at how different styles and categories perform year over year. And you mentioned in the article that it's a roller coaster, and those investment quilts sort of bear that out. If you look at the color codes, what was on top one year seems to be on the bottom the following year, and vice versa. What was on the bottom seems to be on the top the following year.
Yeah, the way I'm describing these investments are when you have this long holding period. When, say, if you were investing for tomorrow or for next year within the next 5, we wouldn't be investing this way because of what you just explained. So that style of investing, that's going to change the way you're allocating your funds. And it really is it's when you look at those quilts, it's like it's a game of chance, right? And so that's where it's like, okay, I would want to be diversified in a lot more sectors than what I just described. But if I have that longer holding period, and we work with Asset Dedication, they're a money management company, and they showed us those quotes, but then they broke it into long holding periods. And as the holding periods increase, those colors, they start to even out, and you can start to see a pattern happen. And so that's what's driving our philosophy of, let's tilt towards this small cap value in our emerging markets when we know we have this long of a time frame.
Yeah. It's interesting. On the one hand, those quilts are helpful. On the other, they're probably harmful because what they end up doing is, I think, appealing to someone's one of their biases, which could be recency bias, where they may tend to invest in what was hot as opposed to thinking about the long term. And those quilts that you mentioned from asset dedication, I think, are especially helpful because they do show that over a 10 or 15-year time horizon, the things that tend to outperform other asset categories with some consistency, I should add.
Yeah, it has been. And it's hard. It's hard too because you get a lot of responses of like, well, the world's different now, and but when it's been consistent like this for so long, it's like, well, why would we bet against it? Like it's kind of like, and to me in my head, the way I think about it is I want to give myself the best chance to have the best return, and so I'll invest this way. And I actually going through school, I remember on average, I think it's since 1927, the small caps had on average returned 12%, large caps 10%. And 2% doesn't sound that big of a difference, but when you add it up over 30, 40 years, it can be almost double the amount of money you have. And so any percentage point I can get, I'm going to try to take.
Yeah. Well, Beau, it's always a pleasure chatting with you. I look forward to your next article, but in the meanwhile, our discussion today and your article below, I think will help a great many people. Thanks.
Great. Yeah, Bob, this was a lot of fun. Thank you.